Happy Thursday, everybody. Good afternoon, good morning, and welcome to Daily Trader. The dust has settled on the U.S. election largely, and still some outstanding races being counted, but for the most part, outcomes understood, markets pricing them in and adjusting things as necessary. We have an S&P 500 that is closing in, at least in terms of the futures, on 6,000 points as we speak here on the morning of November 7th. We are pre-Fed, of course, to note. That is later on this afternoon, and so subject to change without notice, of course, as we get that information. NASDAQ 100 futures crossing 21,000 for the first time. So some historic benchmarks and new all-time highs taking place in the broad-based indices. Here in the United States, as you look elsewhere, a little bit of a bounce back in gold, as well as the treasury markets after some weakness there in that first initial move in response to Donald Trump's return to the White House post his win in the election earlier this week here in the U.S. We got some fun things to look at, though, for today's show. We're going to look at two names that ironically are tied together for a few different reasons. The primary reason, I'll be honest, we're looking at Qualcomm, and then we'll look at ARM Holdings as well, two semiconductor names. But primary reason is they both just had earnings. That was really what caught my eye. But then I remembered these two are in a bit of a spat with one another as well when it comes to some licensing deals. So some irony in that as we're looking at both of these names here the day after we hear from them in terms of earnings. And both of them actually seeing some pretty interesting moves as well. Now, we're going to start with Qualcomm, kind of setting things up as we were going into the report. This is the name that had a really, really strong first half of 2024. It peaked out at around $230 a share. And then it sort of eased back with the overall market as you went into July and, of course, August, where we saw some of that dramatic broad-based equity volatility. When you've seen the rest of the market bounce back, it really hasn't been the case for Qualcomm. This has largely been a name that's been a little bit more range-bound. And if you look at its performance over the last 6 months, it's actually down about 5%. This is all on the heels of what earlier was actually a really nice move to the upside in response to earnings that is normalized. You're actually looking at a stock now that's basically unchanged on the day. After opening over $180 a share, it now has swung to the downside and is actually sub 174 as we speak. So some initial optimism. And when we look at those results and when we really unpack them, this is a name that beat on the numbers that it's shown, particularly when it was the guidance figure that we know is so critical to the response in these stocks in terms of reaction. First quarter revenue was seen better than expected by a pretty wide margin. They announced a $15 billion stock buyback plan, which had the juices flowing on the bullish side for many investors, but not holding and it kind of falling back into that range. For an example trade's purpose, one thing to consider whenever you've had earnings already, you naturally don't have another earnings event on the calendar for a whole nother quarter. So it allows the trader, if they want to extend duration a little bit. As we kind of enter that time frame of what is often referred to as the Santa Claus rally, I looked at a strategy that goes out to the December monthly cycle. December 20th in this case is that date. What we're looking at here is a neutral to bullish strategy. The price action is interesting today. You saw initial optimism, but it didn't hold. And so looking at a neutral to bullish strategy, just seeing if this recent kind of sideways range continues to be a support level, using 170 as our short strike. In that case, we did define the risk, and we bought the 165 strike to create a $5 wide put vertical, 170, 165, and looking for about a $1.75 credit. That $1.75 credit is pretty close to 1/3 the width of the strike's actually slightly more than that. So a little bit better than a 2-to-1 risk-reward ratio. As you see there up on the screen, the max loss on this trade, if done for $1.75, is $325. You find that by seeing that $5 wide spread, you net out the $1.75 and you're left with $325. Of course, option prices times it by 100, you get $325. That means max profit, those debt credit received, which is $175, and the break even at 168.25 would be below that 170 mark by a little bit, which has been a pretty critical battleground for this particular name, really going back to early August. So If that range continues to hold, that support level continues to hold, this strategy would have a chance to be profitable over the next month and a half, as of course it does go out to that December monthly expiration again, which is December 20th. As we shift gears now and look at ARM Holdings here, this was actually an initial disappointing report. The reaction was lower in ARM Holdings. Even as much as going into the open, you saw this stock lower. However, market opens, a little bit of excitement comes into the overall market. Dip buyers came into ARM Holdings as well, and you actually see ARM Holdings up a comfortable 5%. So it's almost like roles reversed. You saw Qualcomm higher, now it's unchanged. You saw kind of an unchanged to slightly lower reaction in ARM, and now it's higher. So always really, really important to allow the market to digest this news, particularly once it opens, as different traders, investors are able to express their opinion on whatever happened post earnings. When we look at that same 6-month time frame relative to Qualcomm, which we talked about being down about 5%, ARM Holdings during that time frame is actually up about 40%. So it's been a really strong performer, despite the fact that it's also about $35 off of its highs. So a name that has struggled, but also really a nice performer, all things considered, too, because of its a little bit higher volatility that you do see with this growth company. From a trading standpoint, again, going out, now we don't have earnings to think about for another quarter. All things, no surprises, of course, in early releases. We're able to extend duration a little bit if we so choose to. We did that for this example trade, going out to that same December 20th monthly expiration. And in this case, looking at a call debit spread. And so the call debit spread in this case is going to be a little bit more bullish than the short put vertical that we looked at in Qualcomm. And it's looking for this stock to get back to its highs that you saw back in kind of early October. Early October, this stock was trading near 165. If you believe over the next month and a half, for whatever reason, that ARM Holdings could get back to that level, this is a strategy that could benefit from that. Now, it's also structured in a way, interestingly enough, where it's only slightly in the money. Perhaps you even could make the case that this is an at-the-money call that's being bought in the case of the 150, that it's actually structured in a way that your risk is half the reward potential. So before we were talking about a 2-to-1 roughly risk reward. Now it's 1-to-2 in this case. So break even then a little bit higher than the current share price. You're going to need a little bit of help from the market. Right now, ARM's around 152. You would need a rally to 155 or thereabouts by the end of this trade its life cycle, which of course is December 20th or expiration date. And you risk 500 in this case. The debit spent on the trade, $5, to make the width of the spread net of that, which is $1,000 or the $10 that would be left on that $15 wide spread. So slightly bigger trade, slightly lower probability trade, but a chance to have a little bit of positive asymmetry and a benefit where if it does happen, you could make upwards of 2 times the risk on the trade, which is interesting and something to think about when structuring these strategies. Oftentimes that relationship between risk and reward is also related to the probability of success. So if we compare the two, break-even was lower in the neutral to bullish strategy in Qualcomm. It's actually higher in the bullish strategy here for ARM. So just naturally, just with that information, you can assess probabilities probably being slightly lower for the ARM strategy, but your chance to make a little bit more money maybe offsets that depending on your nature of your bullishness or lack thereof, depending on individuals' goals and outlooks on these stocks. So 2 names, ironically tied together for a few reasons. Primary one for us, post-earnings, both making some pretty unique moves and reversing a little bit post-open. Thanks as always for tuning into Daily Trader. We'll see you tomorrow.